But we're talking about a couple of numbers. Let's talk about Westlife Foodworld. Reported a decent set of fourth quarter earnings. The company saw strong revenue growth and margin expansion. Let's welcome Amit Jatia, who's the vice chairman of the company, joining in now. Amit, always a pleasure speaking with you. Decent numbers coming in. Let's talk about the granular details of your numbers. In the conference call, you did say that you are eyeing high single-digit SSSG in the next fiscal. Historically, you've added stores by about 10% and price hikes by about 3 to 5%, depending on inflation. So should we add all of that and believe that you can do 20 to 22% sort of revenue growth in FY24?
From a top-line point of view, last year we've added 35 new restaurants. And on top of that, the plan is to add between 45 new restaurants in the coming financial year as well. Along with that, if you look at the high single-digit same-store sales growth, yes, between 18 to 25% is somewhere where we think we should sort of stack up for FY24.
Okay, 18 to 25% is the revenue growth that you're expecting. Mr. Jatia, good morning. That is about the revenue growth. Tell us more about margins, because they are near the higher end of your range, 16% now versus FY27 target of 18 to 20%. So from here on, what will the margin expansion triggers be? Is there a limited upside that we are looking at?
Sure. I mean, the good news is that every year we've been at the high end of the margin. So I'm very happy to say that over the last 4-5 years, leaving COVID period aside, we've been growing our margin by 150 basis points. So unfortunately, you will see next year again at a new high. Yes, we are inching towards the 18 to 22%. And we are quite confident that again next year, that is FY24, we will continue to see margin growth as we've seen over the last 4 to 5 years. We build our business and our plan from a 3-year, 5-year point of view, and we factor things like inflation and other volatilities that are there in the marketplace. So we are reasonably confident that we will deliver our 2027 vision year on year, with growth coming pretty much every year.
How should we look at your revenue growth in FY24 with regards to on-premise and off-premise delivery, or rather off-premise demand? Mainly because on-premise increased on a low base, whereas off-premise declined on a high base. What does steady-state growth for both these factors look like?
I've been saying that we are an omni-channel business and we have to be where the consumer is. And if the consumer is going to consume us both in digital and on the ground. In fact, we've been adding a lot of drive-thrus as well, because that's giving us a bit of competitive advantage. And I think it is differentiating the brand as well. So during COVID, a lot of questions were being asked that should we reduce our restaurant size? Will in-store ever come back? And I think we've proven all right that we maintained our restaurant sizes and in-store has come back. And I wouldn't say that it was off a low base. I think our in-store business has always been very solid. So you will see momentum across the board. It's going to become even through delivery, because if you look at the whole year, even though delivery was on a very strong wicket, having grown substantially over the last 3-4 years, we've still grown delivery from a year point of view in pretty good double-digit numbers. But in-store has come back extremely strong with 85%, pretty much in the last quarter. And I think that is going to continue to grow. And therefore, we are doing experience of the future restaurants. We are continuing to grow McCafe, and we are continuing to differentiate the consumer experience at McDonald's. So I think we will see what I call an omni-channel growth, which is across all parameters, across all channels.
Okay, we take that point. Mr. Jatia, can you give us a sense of what the split is in terms of revenue contribution from in-store and delivery? Is it going to change once you are looking at increasing the experience center, so to say?
Currently, it is at 60-40, and I think, it will stay within that range. Again, I'd mentioned that even when delivery was really growing strong, I believe that in India, consumers are looking for an outing, and therefore in-store will continue to grow. And I do believe the convenience offered by delivery will continue to grow that segment as well.
60-40, 60 in favor of in-store, right?
Correct.
All right. Just on the store addition bit, I wanted to know some more thoughts on how you're approaching this one, because in terms of supply, there are limitations. There's limited real estate. There are higher costs of acquisition. There's cannibalization if you're, increasing the penetration in existing geographies. So 40, 45 stores, you see the potential of almost 1,000 stores plus in the long term. How do you approach it versus in metros, tier 2, new markets? How does that plan come about?
Sure. I mean, first and foremost, it's all based on a very solid research base. We first try to understand where business is coming from in the 356 restaurants that are already there. So if you look at a market like Mumbai, where we have 100 restaurants, you might think we are very heavily penetrated. And take a mini market like Andheri, where we would have, say, 7 or 8 restaurants. So there, we have research that tells us what are the gaps in the market. So based on that gap across the country in our territory, we've been able to figure out that, this 1,000+ potential does exist. Our opportunity and our focus is going to continue in our existing markets, but we are also going to extremely, be aggressive with smaller cities. What we are seeing is in smaller cities, the aspiration of the brand is further sort of enhanced with Experience of the Future, McCafe, with fried chicken in South and so on. And therefore, sales have been very strong. We are also what I call under-penetrated in smaller cities because of a specific strategy we were following. So you will see this, earlier we were 70-30, 70 in tier 1 and 30% in smaller cities or non-metro towns. Now we will move towards the 40-45% and the 50-60% in the tier 1 cities. So that's a slight shift in our thinking. But because numbers are going up, please think about that. Since it's 40-45, the number of restaurants opening in the metros is not going to go down. It's just that the incremental numbers would come also from the smaller towns.
Okay, so the absolute number will go up in the smaller towns, but of course, percentage-wise, it would look like it is lower in the larger cities. Mr. Jatia, your sense on royalty renegotiations, when do you think will that come up?
No, I think we have a pretty robust plan. I think the 5 years are very clearly visible. And I think 5-year visibility on a pretty solid support that we've got from McDonald's is extremely good. We are at about 4.5%, and the highest in the next 5 years is at 5.5%. So we are quite well placed on the royalty side.
Okay, so that is on the royalty side. The new debate that has come up is whether ONDC is disrupting the new age delivery companies. What are your thoughts on the same? They have launched an app. It is, of course, a pilot here, only in Mumbai. But do you think it will be big enough to cause that kind of disruption in the delivery industry?
I mean, firstly, we love disruption. It's great for the consumer because that pushes everybody to really, give more benefits to the consumer in the way they consume, including with cost. I think it's too early to see. We are evaluating the platform. Remember that on the ONDC platform, we have to have our own rider network. Good news is that we do have our own rider network as well. So if we were to capitalize on it, we have our own app and our network as well. So it's a little early, but we are obviously evaluating it. And from Westlife, you can be sure that we will be front runners in using something that is disruptive, as we have done with the rest. Yeah.
Right. Just wanted to understand from you, what proportion of your delivery revenue is currently coming from your own network? How much of that comes in from these third-party apps? And, the ONDC, how would that work for people like you who already have a strong delivery network of your own?
Well, like I said, ONDC is something new and we need to still evaluate what it can bring to us. But I love the fact that it's an option that is available to us now. We've always looked at the 3POs as partners. And, while our own app has been growing extremely well, we don't share the breakup, unfortunately. But important thing is that all of them are moving up quite well. Our own app, we've just refreshed our app quite well. Consumer feedback has been excellent. And therefore, we think that is going to continue to grow.
And qualitatively, if you could give us a sense, you don't give us quantitative numbers. How much that comes up to? I mean, how much would your own contribution be?
No, we don't share that breakup. But good news is that in last 1 or 2 quarters, our own app has seen a pretty good uplift as well. It's because of the refresh that we did to the app. So easier to use, the consumer interface is better. And plus with our own network coming in as well, we feel there's a very good balance. We see the 3POs as partners. We have to understand their problems, they have to understand our problems, and we have to work together to move forward. That's been our approach from day one, in fact.
Okay, all right, Mr. Jatia, we take that point. Thank you so much for joining us and speaking with us as to what the outlook for FY24 is and various other things as well. That's the word coming in from Westlife Foodworld. The stock is in focus high by 0.6% on the back of good set of numbers.